Joining us here exclusively, GlobalFoundries CEO Thomas Caulfield. It's great to have you here. Thanks for being here.
Thank you, Morgan. Thank you, John.
So let's talk about what you're seeing in the current quarter, given the fact that Q1 revenues missed and that you did talk about remaining cautious on the outlook for 2024. How does it speak to what you're seeing across different end markets, inventory corrections, and other dynamics that are afoot?
Lots to unpack there. So let's maybe start a little bit with GF. You know, our results are always based on an amazing team we have, and especially in a down part of the cycle that 2023 left us with, and is kind of carries over to 2024. So I'd be remiss if I don't give a shout out to the GlobalFoundries team. When I think of 2023, remember this was a year that everybody thought the second half would be strong, and persistent high inflation, high interest rates, consumer spending down, that the year became pretty flat for the industry. If I look at what GF did in 2023, if you look for like our peer group, that means semiconductor companies that play in the same end markets with the same technology type of portfolio, we did pretty well. We were on the high end of that performance. We were only down 9%. Revenue down 9%, almost $800 million, but EPS down very modest, right? We still produce about $2.25 versus our peak year in 2022 at $2.38. So really gritty performance by our team. So as we head into 2024, which is to your question, right? What do we see? The good news is we talked about inventory peaking in third quarter of 2023, and now what we've just seen through a lot of earnings, that inventory started to actually come down. That's the good news. The other end of that is while it's coming down, it's still higher than historical norms. So for us, we think this industry, the semiconductor industry in general, except for certain pockets, and we'll talk a little bit about end markets in a second, it needs about another quarter or so to keep working that inventory down and start to get more to the natural demand that's not just working off inventory. And so we see if it's going to be an up year for our industry, then it's going to require a strength in the second half. Get interest rates under control because inflation's under control, get consumer spending again, and keep bleeding down that inventory.
I mean, we've also starting to see the shift to more advanced chip making, including in areas like communications, infrastructure, data center. How does that affect you, given the fact that it's not an area where you're manufacturing?
Look, we have tons of our customers that say, I can't afford to be in single-digit nanometer. It's for applications that's all about high-speed digital compute, lowest power per transistor when the transistor's on. The types of technologies our customers need for the end markets we serve, it's how do you minimize power when the device is in sleep mode, when it's waiting, like a surveillance camera, like a chip in a car where power usage and energy efficiency is a premium. And so the market is still heavily dominated in the types of technologies we produce. Your question before that, where do we see strength in end markets is, for us, automotive was a great outcome for us. We went from $320 million in 2022 to over $1 billion in 2023. Great growth. Even with some of the softness that you hear from others, we still think we'll have meaningful growth this year because of the range of applications we service. And even if units are somewhat soft, content per car continues to grow.
Well, what about the macro? Because one of the things that you called out at the beginning of the earnings call was customers grappling with tighter monetary policies and kind of a hope that would ease up. But we got this CPI number today, which is suggesting to a lot of people and to investors that maybe things won't loosen up so soon. So to what degree is that going to affect your outlook for the year?
I think that's back to what I was speaking to. Look, it's good news that it's down to 3.1. It's a little bit higher than kind of the call was around 2.8, 2.9. So it's not way out of whack. It would have been nice if it was a beat on that and coming down sooner. And I think this is really coming down to at what point does inflation get under control so the Fed can loosen interest rates so consumers feel more confident to spend on durable goods. And that's why I think the combination of those dynamics plus bleeding off inventory means this is really a second half of 2024 for our industry, kind of writ large in the broad range of our industry.
So when we look at microchip, when we look at J-Bill, we're both talking about similar sorts of, demand questions overall for the kinds of, sweet spot, not the leading edge manufacturing, but that core stuff that you guys make. Is that a decent proxy for also how you're looking at the market?
I think it's a little bit broader than that set, but there certainly would be, and their Jabil's a little bit different. They do assembly, where Microchip's more of a manufacturing company and a semiconductor company, they would be a subset of a bigger group of, say, 15 stocks that I think is a good proxy for where we are.
Quick question for you. CHIPS Act funding, we're starting to see more of it come down the pipe. You're a trusted foundry. Expectations that you're going to see some sort of funding here this year?
Look, I think GlobalFoundries plays an important role in the world semiconductor industry, and in particular here in the U.S. And it's important that we participate in a program like that. These programs are under confidentiality, so we can't talk about it. But I would tell you, I'd stay tuned on that one. I think the White House wants to start getting this money deployed so that the chip industry can come back home.